Hey guys, good afternoon and welcome to the CNBC-TV18 Mumbai studio. I'm Pavithra. With me is Sonal as always. And today we're going to talk about how you can really go about creating an aggressive portfolio. Now, consider if you are someone that really wants to, maybe you have the capacity to take higher risk than usual, you want to stay invested for a long time, all this in the bet to, try to maybe get better returns. How do you go about creating this aggressive strategy? What should you really do? And how do you sort of understand if it's even right for you or not? Sonal, let's put all of these questions to our guests and find out.
Okay, so aggressive strategy, that's maybe something that everyone is watching out for as well. But of course, that comes with a lot of disclaimer. On that note, let's welcome Nasser Salim, who is the managing partner at Flexi Capital, joining us now. Nasser, good afternoon. Thank you so much for joining us today. And when we are talking about aggressive portfolio, it's important to demystify that term first up. What would you classify as an aggressive portfolio? What are the main characteristics of this particular class?
Good afternoon to you both, and thank you very much for having me back again on the Mutual Fund Corner. I think, Sonal, Pavithra, very key important points. We see a lot of clients, investors now getting into aggressive mode. So I'm glad we're doing this discussion today. I think predominantly an aggressive portfolio will have higher risk tolerance. An investor or a portfolio which is aggressive in nature needs to necessarily understand that there is a longer investment horizon, a clear understanding of their principal at risk in shorter intervals of time, and it's more obviously inclined towards equity and equity-oriented schemes. And simply the way we put this in a classroom session is a higher risk-adjusted return as compared to the benchmark. And the portfolio will have aggressive bets on certain concentrated sectors and themes, Sonal and Pavithra. I think that is something which is going to define an aggressive portfolio as against a moderate or a conservative portfolio. And obviously, which needs to have a longer duration on the investment horizon. I think these are some of the most important parameters or characteristics, rather, in an aggressive portfolio.
Okay, got that. But now the next important question is, who is an aggressive portfolio really suitable for, and what do you need to check in order to understand if this kind of portfolio is really good for you or not? Because, it's very easy to be an aggressive investor till the market actually corrects, right?
Right. Absolutely, Pavithra. I think, when we go back to looking at our class of investors, I think that there's a distinction between investors who have prior knowledge and experience in investing. Today, we're seeing a lot of FOMO, that fear of missing out on equity returns, for example, people have discussions. But I think the most important point is, do you have enough opportunity, prior knowledge and experience in investing in equity as an asset class? I think that is the foremost important point. The other very important point is that, people have started taking equity as, to say that, you can't lose capital. I think somebody who understands and who's experienced losing capital is an ideal investor for equity. I'm not saying that you must lose capital, but you may have experienced losing capital because there is a lot of risk at capital at shorter periods of time in equity. So the right horizon is something which is very, very important. I think the other very key important point is between all your investments, whether it's real estate, fixed income, fixed deposits, gold, other precious metals, ornaments, I think, equity as an asset class has somehow the highest risk tolerance. So when you invested as an investor, if you invested in multiple portfolios or portfolio sets, equity as an investment class will give you the highest volatility in shorter periods of time and may also ensure that you might end up getting the highest returns. So, it's an equilibrium that you need to understand. And therefore, prior knowledge, again, as I said to you, suitable for investors who have had a high risk tolerance. Repeatedly, that word is very, very important.
Okay. So in that case, how would you suggest that one can go ahead and create an aggressive portfolio? What would you consider the guiding rules to follow if someone wants to start the journey or they're already doing that?
So I think that's a very pertinent question. I think two key things here have to be understood. Number one is when you're creating a portfolio, an aggressive portfolio, we need to understand what is your core. I will define this in two parts, actually. One is core and the other one is satellite. At the beginning of the show, we just spoke about how you take certain bets on you take certain concentrated bets on themes and sectors. I think, the important point here to note is that when you're creating a portfolio, we need to understand what is the kind of exposures you can take on those sectors or themes. or concentrated bets that you wish to have exposure to in an aggressive portfolio. I think the foremost is two very key important points. Number one is reasonable long-time horizon. Number two, differentiation between core and satellite. We like to use the word thematic as satellite, and broadly, the attribution that we follow is 70% should be ideally in core portfolio, which is a mix of all, it's the foundation of the portfolio, which is basically, it includes spreading investments across different market caps. So, you have large, mid, and small, and which will lead to a more aggressive approach to the portfolio rather than only being in large caps or mid caps, for example. And the other one is, of course, having a satellite portfolio, which consists of more specialized and sectoral specific funds designed to enhance returns or target specific opportunities while accepting higher risks, leading to higher returns. So the split broadly is that what we are suggesting is 70-30. 70%, if you have 100 rupees, you invest 70% in core portfolios across market caps. 30% can go into sectoral bets, and then we look at statistics. When we're creating an aggressive portfolio, we look at 4 broad parameters, right? Which is you track alpha. So something like an aggressive portfolio will obviously have a higher alpha as compared to its benchmark. We look at an aggressive portfolio in terms of beta. These are very common terms. We've gone through them innumerable number of times in the past. I think beta is something which we track very closely when in an aggressive portfolio. So it'll have a beta of more than 1. A standard deviation, something very, very important in all our discussions today. A high standard deviation of 18.5 roughly would be an aggressive portfolio, which should be considered when you're looking at a portfolio from an overall perspective. And something which is a very simple ratio called a Sortino ratio, which is seen in an aggressive portfolio, which basically means more return per unit of bad risk. So when I look at all these factors together, that is how a suitable portfolio for about a period of 5 years, when you look at all these parameters between core, satellite, and the 4 key metrics that we've identified at the moment, will be the real backbone of construction of an aggressive portfolio.
Okay, so that is how you can really go about building your own aggressive portfolio. Nasser, you were just talking about FOMO when the market is at record high. So do you think that if you're creating this kind of aggressive portfolio, which means you're probably deploying high amounts of cash, do you think it's okay to do that when the market is at all-time highs? Or do you think because the market is at all-time highs, maybe you should just go about it in tranches so that you sort of average out your rates?
Pavithra, again, markets have been all-time high, yes. If you look at price to earning bands, our scorecard tells us that everything is in the red, barring a few sectors. This is all, again, cyclical, right? I mean, today, earnings will start to show improvement. And if prices remain the same, values will become far more attractive. And that is what we are betting on for the next few quarters. But I think to answer your more important, your point, when you're looking at in today's scenario, I think tranches or truncated investment opportunities are far better option. Cash is king in markets like these. We feel because there could be opportunities where you may get a dip and you may want to enter at a certain valuation level. And I think a concentrated bet on sectors with truncated, which is in tranches, as against lump sum, may be a better idea. So we use the rupee average cost of methodology, which is you buy in at dips and hold on to cash and continue to buy in. Obviously, there is a limited amount of cash which you can keep because there's also an opportunity that you may miss out. But I think a strategy in today's time, given where we are in terms of price to earning bands across sectors, I'm not looking at only Sensex or Nifty in this case, Sonal, Pavithra, across sectors, we are in expensive valuations, barring a few, as I said, and there, cash allocations in dips may be a good suggestible idea.
Okay, all right. So, Nasser, there are fund houses and styles like Quant that have been able to deliver higher alpha versus the others, but come with high risk as well. Is it a good idea to concentrate your money in these names?
So, again, to both of you, what I would say to your viewers is there are different styles of investing, right? There is Quant, there is growth, there is value. And Quant obviously uses certain statistical tools and mathematics-based algorithms which are used to buy in, and there's no human intervention ideally. Now, we've seen in various, which ideally mitigate risks, from a Quant perspective. But we've also seen where many Quant funds may not have delivered the highest alpha, right? So we personally feel that a Quant fund can be looked at, but at a very small percentage. We are more gung-ho about the valuation methodology, and therefore, like for example, in the last 2 years, we've seen a value picking of stocks delivering far better returns as compared to growth. Growth happened between 19, 20, and 21, all the way up to 2021 October. So the fund managers which were adopting, or investors who are investing in growth style fund management skills did very well. All of a sudden, those fund houses are not doing that well now, and we've seen value picking up. So there is no one fit formula for all. But what I would suggest is we look at the broader picture in terms of price to earning, and then you allocate funds basis which style you prefer. Currently, value is delivered. There could be a situation where growth may come back in a few quarters, and therefore it has to be more strategic in nature and not just one fit for all.
All right, got that. And Nasser, now, we want to get to the numbers and really understand how much you need to invest if you want to get to a certain, big amount of money. So we're going to get to that in just a bit. But first up, we do need to get into a short break. We'll continue our conversation in just a bit.
Welcome back. You're still tuned into MF Corner. We still have with us Nasser Salim, the managing partner of Flexi Capital. We are talking everything about creating an aggressive portfolio. Nasser, let us give you some numbers because that's what people would like to know. Let's look at two scenarios using an aggressive approach. Someone who wants to create 5 crores in 10 years, first via lump sum. So how much will you need to put in right now? If you can give us the answer to this first scenario.
Yeah, hi. Okay, so what we've assumed in this case is, I'm assuming is that 5 crores at inflation adjusted number will be close to about 9 odd crores. So that's the first assumption that we're taking. Number two, the second assumption we will take is, as you've obviously mentioned the time period, we will take an expected return of 15% on the equity returns that we will use to arrive at that number. So again, just for your viewers, 5 crores, as you mentioned, inflation adjusted after 10 years will be roughly about 8.95 to about 9 odd crores. So that's the number. So in looking at an inflation of 6%, we're looking at a total investment of currently 2.21 crores, which will grow at a CAGR of 15% for a period of 10 years, which will be an estimated value, return perspective, of about 6.74 crores. So the total value of 5 after 10 years, 5 crores in 10 years will be 8.95 crores. That's basically inflation adjusted number on the lump sum that is required to be invested.
All right, so that's how much you would need to put in and what you would get if you look at it on a lump sum basis. But with SIPs, the magic of compounding does half the work for you, right? So if you're looking at an SIP, how much will you need to put in every single month?
So again, we'll use the same presumption, which is inflation at 6% and growth at 15% per annum. And CAGR in this case, obviously over 10 years. So if you look at a SIP, a simple systematic investment plan, a monthly inflow will be of 3,21,335 Indian rupees as of today, and that's the SIP over the next 10 years to generate a return of 5.09 crores, where your investment amount, principal amount invested will be 3.85, and the return will be 5.09 crores, adding to a total value of 8.95 crores again.
Okay, take that point. Now the third part to this, via step-up SIP, how would you do that? How much will you need to put in every month, and how much do you need to increase it every year to get that amount that you need?
So in this case, in a step-up SIP, what we've done is, I would say that we need to allocate, and we've again gone with an assumption that there is going to be a disposable cash flow for investing of availability of approximately 10%. So assuming that you, for example, if you're looking at 100,000 today, next year you should have available surplus of 110, which is basically 110,000 additionally. So what we've done is we've kept up a step-up rate of 10%. That's the assumption we've made in this model. And again, and an estimated value of 5 crores inflation adjusted after 10 years will be 8.95. There, with an annual step-up of 10% incremental cash flow, you need to start today, as of now, for an amount of 2,26,300 rupees. Broadly, and with a step up of 10%, it goes up every year by 10% of the base amount, and the expected rate of return, and again in this case is 15%. The invested amount in 10 years will be 4.32 crores is your principal. The estimated return on that will be 4.62 crores over a period of 10 years. again, adding up to a value of 8.95 crores.
Okay, understood. So that is how you can go about trying to create 5 crores in 10 years, of course, adjusted for inflation. So, looking at slightly higher figures there. Nasser, now let's talk about a slightly higher figure. Consider someone who wants to create 10 crores, but they're willing to wait 20 years for this. So they, are willing to invest for that long. Again, same as last time, how would you do it and how much you need to put in if you are looking at only a one-time investment?
So again, lump sum here, we're looking at, again, this is, an inflation-adjusted number of, actually, it's since you mentioned 10 crores in 20 years, we've taken inflation-adjusted at 6% historically. And that the value of that, again, comes down to 32 crores. So, the point is that we need to look at inflation at a very important factor when you're looking at this. And obviously, you'll have more pool of money available to you. So that's why we put in inflation numbers here. The 32 crore number is huge. It obviously looks big in 20 years, but I think the power of compounding is visible there. So here again, the total investment is what will be required is lump sum is 7.92 crores at an estimated return of 15% over a period of 20 years. So your estimated return over compounding annual growth rate at 15% adds up to a 24.14 crore. Now that's a whopping number, and I think the point is that patience has always delivered huge returns on equity, which is evident from what we're trying to tell you. And therefore, the estimated return is 24.14 on a principal amount of 7.92, which adds up to 32 crores.
Okay, all right. Okay, so let's take this forward and talk about SIP. How much will you need to put in every month in that case?
In an SIP, it will be 2,11,558 rupees. Again, over a period of 20 years, inflation adjusted, 32 crores is the number that we're looking at. Estimated return will be almost 27 crores. With your investment amount of only 5 odd crores. So that's the big jump again that you see.
Okay, and the magic also happens when you're willing to step up your SIP, right? Because you're going to need less than half of this amount.
Absolutely, absolutely. And therefore, the numbers are evident in front of you. Inflation adjusted, again, 32 crores. Monthly investment as against a simple SIP was 211,000 rupees earlier. In a monthly investment with a step up, again, we're looking at 10% disposable cash flow. It adds up to 1,15,000. So it's almost halved, if you can see. Sonal and Pavithra, it's actually halved from just an SIP. And there again, your investment amount remains to be 7.91 crores and an estimated return, which is the growth value, is 24.15 crores. And therefore, the number again adds up to 32.07 crores. So it's 1,15,000 with step up every 10% every year.
Okay, all right, Nasser. Thank you so much for joining us today and sharing your insights into how one can go ahead and build an aggressive portfolio. That's all we have on the show today. But you stay tuned for Closing Bell to take you through the last hour of trade because it's turning out to be an exciting one. So stay tuned to CNBC-TV18.